Hey there, welcome to Investing Path. It is all of us here, and if you've been following the news, you'll likely come across headlines suggesting that the US is teetering on the edge of a recession. The looming debt default could potentially trigger the downfall of the dollar, and the so-called everything bubble seems ready to burst. The S&P 500 has taken a nosedive, and there's a new Starbucks drink causing unexpected bathroom visits. While it is not entirely unfounded, negative headlines tend to generate more attention. However, there is genuine concern about our economy slowing down. With the debt ceiling deadline just around the corner, we will see Warren Buffett sell his stocks and signal an approaching end to the remarkable era of the US economy. Now, we believe it is essential to debunk these claims, delve into the latest findings regarding the possibility of decreasing inflation, and explore how you can position yourself to seize the opportunities that lie ahead. Thank you for all your support, and without further ado, let's get started. Alright, let's dive into the heart of the matter and explore what's truly unfolding. When it comes to our economy, one crucial factor that has taken center stage is inflation. It has become the key metric that impacts various aspects, including interest rates, stocks, and housing. The higher inflation goes, the more rates must stay elevated, and the more stocks and housing prices may decline. However, the situation with inflation seems to be showing some signs of softening. Or does it? The widely discussed inflation measure is known as the Consumer Price Index or CPI. It tracks the weighted average of common consumer purchases on a year-over-year basis each month. However, there is a flaw in this calculation, as it may not be entirely accurate. Some items included in the inflation calculation are highly volatile and experience significant price fluctuations in the short term. To address this, a concept called core inflation was introduced. It intentionally excludes food and energy, which are known to be more volatile due to external factors. So, what's happening between these two measures? Well, it's a mix of good and bad. Let's dig deeper. At first glance, inflation has dipped below expectations, falling below 5% for the first time since 2021. This implies a 0.4% increase in inflation on a month-over-month basis. Even if this pace continues throughout the next year, we would remain below 5%. So, why is this good news? Well, the cost of fuel, energy, natural gas, and transportation services has decreased on a monthly basis, apart from used cars and housing, which we will discuss shortly. Most other categories have seen only modest gains. Now, let us focus on its specific figures. On a year-over-year basis, food prices have seen one of the largest increases at 7.1%, with cereals and baking products reaching a staggering 12.4%. Food consumed away from home, such as restaurants, has also risen by 8.6%. You're probably experiencing the effects of inflation more than what this report suggests. Similarly, vehicle repair, frozen vegetables, and insurance have seen significant annual prices increase. However, over the past year, energy costs have declined by an average of 5.1%. Since energy makes up a substantial portion of the average American budget, it tends to have a downward effect on inflation. Yes, you heard it right. There's even an entire index dedicated to tracking the inflation-adjusted prices of bacon. You truly learn something new every day. While these developments may sound most positive, there's another side to consider: core inflation. As mentioned earlier, this measure excludes food and energy prices. When we analyze core inflation, we find it sitting at 5.5% on a year-over-year basis, with a 0.4 increase on a month-over-month basis. Though this may not seem like a substantial change, it has remained consistently high since the beginning of the year, despite rapid rate increases. The unfortunate consequence of persistent core inflation is that interest rates may need to remain higher for a longer duration unless this trend reverses. The housing sector further contributes to this concern, as it continues to be the largest driver of inflation. In April, the cost of shelter increased by 8.1%, only a slight decline from 8.2% in March. This accounts for over 60% of the monthly increase in the index for all items, excluding food and energy. This is indeed a significant factor to consider. Thankfully, there's some good news on the housing front as well. The calculation of housing costs primarily considers existing lease agreements from a year ago, and may not accurately reflect the current market conditions. As rental prices begin to decline, we may witness a decrease in these figures toward the middle or end of this year. Furthermore, it is worth noting that Jerome Powell, the head of the Federal Reserve, recognizes that housing tends to be a lagging indicator. In response, he reportedly looks at a concept known as supercore inflation, which excludes housing from core inflation. By systematically chipping away at the factors that contribute to high inflation, we can anticipate a more positive outlook. Anyway, let us discuss how the situation impacts the rest of the economy. There's one topic that you'll be hearing about incessantly, and it has a profound influence on various aspects, including stocks prices, interest rates, housing prices, and rate hikes. We're talking about the debt ceiling. Simply put, the debt ceiling represents the maximum amount of money that the US economy can borrow to fulfill its obligations, such as paying federal employees, funding Social Security, covering the interest on the national debt, and even hiring elevator attendants to assist Congress at a cost of $440,000 per year. Once this limit is reached, there are two options: either agree on raising the debt ceiling to borrow more or face the consequences of a government shutdown and potential default on debts. Needless to say, defaulting would have severe and far-reaching consequences. To understand the origins of the debt ceiling, we need to travel back to 1917, when Congress held direct control over authorizing government spending. Every expenditure, whether related to war, infrastructure, or investments, required individual approval through congressional voting. However, during World War I, Congress introduced the Second Liberty Bond Act, which established a ceiling on new bond issuances and spending limits. This transitioned the spending process from a case-by-case basis to a system with more flexibility, akin to using a credit card with a predetermined limit. And as you can imagine, this setup has its risks. With the credit-like system came the need for a credit score, as the United States informed other countries of its likelihood to repay debts. Currently, the US holds a 4A rating, signifying that it is considered extremely safe for lending due to its history of never defaulting. However, the level of government spending has been spiraling out of control. Reaching a new debt ceiling requires one side to concede, or else chaos will ensue. Should we be genuinely concerned about this? Firstly, let us address the fact that Congress has a penchant for spending copious amounts of money, regardless of political affiliation. However, despite coming incredibly close on multiple occasions, the United States has never defaulted on its debt. There was a technical default in 1979 due to a check processing issue, and in 2011, the S&P 500 credit rating agency downgraded the US from AAA, resulting in immediate declines of 5 to 7% across all three stocks indices. As it stands, the debt ceiling has been the primary leverage point for fiscal policy in the United States. Unless one side budges, we are heading for a stalemate. In terms of how this affects you, Moody's Analytics predicts that a prolonged standoff could result in a nearly 20% decline in stock prices and a contraction of over 4% in the economy, leading to the loss of more than 7 million jobs. However, honestly speaking, I don't believe this is a cause for immediate worry. The consequences for defaulting would be far worse than agreeing to increase or decrease spending. I believe that no one is truly willing to risk being responsible for the first ever default in the United States, despite any pretense otherwise. Instead, it may be more prudent to pay attention to the thoughts of Warren Buffett, who recently shared some valuable insights that deserve consideration. In their latest shareholder meeting, they discussed the sale of $13 billion worth of stock for cash, emphasizing that the incredible period for the US economy has been coming to an end. Over the last 6 months, we have also sold $25 billion worth of stock during this same period. These actions have raised concerns among investors, leading to the belief that holding cash might be the safest option. Additionally, we highlighted 3 main concerns for the US economy: China, the banking sector, and commercial real estate, all of which have the potential to trigger an economic downturn. From our perspective, we believe it is prudent to temper expectations for the market in the coming years. Projecting annual returns of 15 to 30% consistently is not sustainable. Consequently, it is more important than ever to ensure proper diversification, maintain a reliable source of income, and hold cash reserves as an emergency fund. While it may sound mundane, adhering to this approach and adjusting expectations will position investors favorably for long-term profitability and success. Thank you so much for watching this video on Investing Path. We hope you find the discussion insightful and helpful in your investment journey. If you enjoyed this content and want to stay updated with our latest videos, make sure to subscribe to our channel and click the notification bell. We appreciate your support. We value your thoughts and opinions, so please feel free to leave a comment down below. We read every comment and love engaging with our viewers. Thanks again for watching, and we'll see you soon.